What's going on with inflation and rising interest rates in America right now? The Fed just had another interest rate hike. We are going to explain what this means for real estate agents, why the Fed is doing this. I interviewed my good friend Max Leaman, and he has probably the best explanation of inflation that I have ever seen. So stay tuned and like and subscribe for future videos. All right. So, we were talking, we had happy hour last week, week before, and we were talking about a variety of different subjects. And you broke down inflation for me in a way that I thought could be useful to a lot of realtors or anybody else that happens to watch this video or listen to our podcast. So let's start that conversation from the beginning and tell me what your take is on it and try to recreate the magic from the other night. Okay.
Yeah. So, we keep hearing these numbers. Inflation is up. August, it was 8.3%. September, when the number came out, it was 8.2%. One of the core inflation, core CPI strips out food and energy. CPI, yeah. Consumer Price Index. Okay. All right. The core, so you've got your CPI, right, which is your Consumer Price Index. That is a measure of inflation. That is the 8.2, 8.3 number that we've been seeing, right? 9% or whatever, 9 point whatever it was in June. Yep. Core CPI strips out food and energy because the government says in their mind they can't control the cost of food or energy, right? They can't control the weather, things like that. Yeah. That rose more than was expected. But essentially what happens is every month when a reading comes out, you'll hear it's, 0.6 or 0.7 or whatever it is. When the numbers come out, you're replacing the numbers from last year. So you have a 12-month period and you add up those numbers for the 12 months, right? August, September, October, November, so on and so forth. When you look here, and this is what I was showing you on my phone, last year in July, August, and September, inflation was at its lowest points, right? So you're, what is that, 0.3 in July, 0.2 in August, and it says 0.3 in September, but a little bit less. Yeah. Those are at the low points. So when you're looking at over a 12-month period, you're adding all of those up. Now, when the numbers come out in June, obviously this year it was significantly higher, and this bar is set quite low, right? So now you've replaced that number. July comes in, August comes in, it's even lower last year. And then September was lower as well. So when you're replacing those numbers and you're adding in a higher figure, it increases the overall inflation figure for the year over year.
Okay, wait. When you're replacing those numbers with what?
The new numbers. So you're replacing last August with this August. August 21 is now being replaced with August 22. Sure. Right? When you look at October, and we kind of knew that this was going to come, right? There's a lot of forecasters out there that have been talking about this all year. When, in May, people are saying inflation.
Well, when you say October, you're talking about last year.
October last year. Yes.
Right, okay.
So when you look at October 2021, we were up 0.6, right? Now, we don't know what the number for October is going to be. Yeah. The reading will come out in November. Yeah. Right? However, if it's 0.7 or 0.8 or whatever it is, right, you're only going up about 0.2 because you're replacing this 0.6 figure. So the bar is now set higher. You've removed these low-end numbers. Okay. So now that these are out, when the November reading comes out, we should see some measurable difference of inflation going down. Right? Now, who really knows? But when you look at the charts and you look at the numbers, this is kind of what they show. Mortgage rates follow inflation. They have for the history of time, with the exception of quantitative easing. Quantitative easing is when the government is coming in, buying up mortgage-backed securities, buying treasuries, this kind of thing. So when you go look, like right here, you can see inflation and interest rates. The top line's inflation, those are interest rates. Quantitative easing through the beginning of January 2020 through this year, right? kept rates artificially low. As the Fed stopped buying mortgage-backed securities, started saying they were going to let things run off, you can see that that's when rates started rising.
Right. So they stopped buying those because they felt like they didn't need to anymore because the economy had what? Explain that.
Well, essentially what they're doing is they were keeping rates artificially low during all of the pandemic and everything else, right? They're printing money left and right, trying to keep the economy from coming to a complete halt.
Yeah, and so it's like almost like they went too far with it.
They did.
Yeah,
absolutely. So they did a good job of doing what they wanted to do.
Yeah.
Right. But rates should have never been at 2.5%.
Right.
Or 3%. That's unrealistic, especially as inflation starts rising.
Yeah.
Right. So as inflation's going up, they're keeping interest rates low. They kept saying, well, inflation's transitory. It's transitory. You know, this is temporary. And clearly that's not. And they've since said they don't really understand inflation. You know,
that's pretty bad. I mean, I don't understand it, but
I understand enough to be dangerous.
Right.
You know, so now what we've been seeing is some of this is rates following inflation and rates also getting back to where they should have been.
Right.
If the Fed wasn't buying up mortgage-backed securities.
Okay.
And treasuries.
Yeah.
Now that they're not, and inflation's still running really, really hot. Right. This is why we're seeing mortgage rates spike, and we are now well into the 7%.
Yeah. Okay. Gotcha. So the rates are going, and I think one of the reasons we brought this up was that I had read there in a New York Times article, and there's two schools of thought. Right. One is that some economists or experts are saying, okay, you've done what you need to do, and it will take several months for the effects of that to happen.
Typically, when the Fed raises rates, it takes 3 to 6 months to see that impact.
Right.
Right. So we're just now, when they started raising rates, we've just now really gotten to that 6-month mark.
Yeah. And then the other school of thought is that if you don't keep going and keep raising rates, this is going to only be, you might have a temporary pause, and then we're going to be back to, prices shooting up in every sector, right? It's housing, it's automotive, it's, because we not only have, it's not just an inflation issue, it's a supply issue too.
Well, supply and demand, right? So the reason that the Fed wants to raise rates so quickly, they need to get money supply out of circulation. Yeah. Right. If I have, if I have my monthly goods, when I'm buying my goods, right, I'm just going to throw out numbers here. Yeah. $2,000 a month is what I'm spending. Yeah. Right? Now I have a fixed income because I have this fixed interest rate say on a mortgage, right? I have a fixed interest rate, and I'm getting $3,000 a month for 30 years off of this. Right? Okay. Now, my price of goods starts going up, but I'm still only getting $3,000 a month, right? So I'm going from $2,000 to say $2,500. So now I have $500 less disposable income. I need to be able to make that up. So mortgage rates start to rise because of that, right? As inflation starts to come down, the price of goods starts to come down, right? You have more buying power. You can start lowering interest rates again. What the Fed's doing by raising the Fed fund rate, which is, by the way, that's the daily rate at which banks borrow money. Yeah. Right. They're trying to reduce buying power, bring down demand. Right. So when demand comes down, prices start to come down, and that's how they're trying to curb. That's how they're trying to curb the inflation.
Well, what do you think? Yeah.
I don't know. I mean. Yeah. It's a
different type of thing than we've seen before.
Well, we haven't seen anything like this,
right? Because of COVID. I mean, and the supply issue. I mean, like,
well, it's all right. I mean, we printed trillions of dollars during COVID. We gave out massive amounts of stimulus money to people that didn't need it. Yeah, I mean, I know some people that need it. I know other people, some in the service industry, that were making more money from stimulus money
that it wouldn't make sense to go to work.
Right. I mean, that was the problem. Yeah. I know people that were getting $8,000 and $10,000 and $12,000 in stimulus checks for childcare and all of this, that their income never went down.
Yeah.
Right. So you have all this extra money, right? You have people have a ton of money in savings.
Yeah.
Then you have supply chain issues because you can't get anything out of China and everywhere else, right? So, but people have more money, so now I can start paying you more money for your goods.
Yeah.
And that's what drives up.
So what would have happened? Let's say the Fed didn't step in and like raise their interest rates, or they raised it only a little bit. What would have happened at that point?
Who knows? I mean, you know, the Fed had to do something, and the tool that they have is raising interest rates.
Yeah.
They didn't have a choice.
Right.
I mean, I say who knows. I mean, prices would have continued to go up,
and then would have had a hard fall. So,
Yeah,
so basically, the whole reason they're doing this is to prevent a like massive, huge recession, right? Like, and the school of thought is that they're going to cause a little bit of pain instead of a lot of pain.
But now, what they should have been doing is dealing with all of this last year.
Yeah.
Right? They didn't.
Yeah.
The problem is, and Jerome Powell said it earlier, we clearly don't know what we don't know about inflation.
Yeah.
Right? These are the most powerful people in the world controlling the money supply. They don't understand. Yeah. This is a problem.
Yeah.
Right? Had they started raising rates and trying to tackle inflation last year, this could have been a gradual thing.
Yeah.
But they didn't, and now we're in the problem that we're in.
Yeah.
At some point, now it's expected that they're going to raise the rate another 3/4 in November. It's expected they'll probably raise the rate another 50 basis points in December. However, who knows what they're going to say in November? Just this morning, I was reading that now, maybe investors are thinking maybe they'll change their tune for longer term. You know, I've also read some
Wait, meaning what?
that maybe they won't be so aggressive with future rate hikes.
Oh, okay.
Right?
The investors, or I mean the Fed?
The Fed.
Yeah.
Yeah. So, you know, we'll see what happens.
Yeah.
What I can tell you about mortgage rates is at some point they are going to turn around.
Yeah.
And, you know, there's two schools of thought, right? Either they're going to drop really quickly or they're going to go down gradually. You know, I don't know what's going to happen.
Yeah.
Some people think that we could see rates back in the low fives by December, January.
Really?
I don't think that that's possible,
Yeah.
but there are some people that well-respected forecasters and economists that say that. Others say maybe it could push to March.
Right. Not very likely to see interest rates in the low fours.
No.
And nor should we.
No. Well, you know, to say that's out of the question forever, absolutely not.
Right. No.
But I think, you know, in the next 12 months, I think it's reasonable that at some point we're going to see rates back in the fives.
Yeah, in the fives.
Yeah.
But I think for people that haven't been following this long, like, you know, I have a 3.5% interest rate.
Right.
And that's like, that's like super duper low.
You're probably never refinancing that.
Right.
Right. Now, people that have rates in the fives now will probably have an opportunity in the next 2 years to refinance. Yeah. You know, I've been doing this 21 years. Mm-hmm. When I got in the business, if I could get you 7%, you were amazed.
Yeah.
Right? The majority of my career, rates have been kind of in that 4% range. You know, I remember in 2018, there was 2 days where, you know, 2018 was not a great year. Rates were coming up. There was 2 days where rates were over 5% and everybody was freaking out.
Yeah.
Then they came back down a little bit. Then 2019, you know, you start seeing them in the 4s and high 3s again, and that kind of carried through to 2020.
Yeah.
And then when COVID hit, we saw everything just drop substantially.
Yeah.
So, you know, it's those people that were able to lock in rates in the low 2s, low 3s. Yeah. You're never doing anything.
Right.
But, you know, if you can have a rate at 4%, 5%, 6%, even 7%, it's still historically low.
Gotcha. Yeah. So, okay, that brings me kind of to the next question, right? I think one thing we talked about with Happy Hour a couple weeks ago was, you know, one of my agents had put a TikTok, Karen Banks, about, you know, buying the rate down because, all right, and I might eat my words on this. I've said it a lot, okay? I just don't see very much more of a decrease in price and value of homes over the next 12 months. Okay. I can't predict, obviously, but I'm going to guess that we're going to have a little bit of a push come March, because I think a lot of this stuff will be washed out. And even if it's not, we're in fucking Austin, Texas, right? And this is like the hottest job market in the world. Everyone wants to be here. Everywhere you go on your travels, when if you're in a group of people and they're like, "Where are you from?" Dallas, Orlando,
right.
And you say Austin, everyone will turn like, "Oh, Austin's so cool." Am I right?
Yeah.
So it's like it's just cooler than other places.
Right.
So it's like, I think that this is going to turn around. So getting back to the TikTok video that the agent put out there, which was, here's what you do. We have negotiability right now as a buyer.
Yep.
You offer less on the home if it's not the first weekend, and then you get your closing costs and you buy down your rate for, what is it, $5,000?
Well, so maybe. I mean, there's a lot to unpack there, right? So let's say we have a $600,000 house, right? And you're going to put 20% down. Your loan amount's $480. Right now, so if you look yesterday, the average rate yesterday is 7.37.
You want some Nicorette?
No, thank you. Average rate's 7.37.
Do you mind if I vape too?
I don't care. Okay. Do whatever you want. So the average rate. Anything else you want?
No, good. Sorry to interrupt you.
No. So, all right. So, shit, you made me lose my train.
Average interest rate.
Yeah, so average interest rate yesterday. It's 7.37. So let's say you're getting 7.25 with a point, right?
With a point.
7.25.
That's the buy down. Okay, that's the cost.
So let's back up.
Okay.
How do I say this? If par rate's 7.5%, par rate meaning you're not paying any points to get anything.
Yeah. Okay. Gotcha.
The rate is 7.5%. You can pay 1 point, which is 1% of the loan amount, which will typically buy the rate down 1/4 to 3/8 of a point, right? So maybe instead of being at 7.5, your rate's at 7.25.
Right, and you used to be able. Would you used to get more bang for your buck with that?
Well, now you're not. So there was earlier a period of time this year where 1 point would lower your rate maybe 0.5 point or 3/4 of a point.
Yeah.
Right. So everybody talks about buy downs and I want a lower rate and I want a lower rate.
Yeah.
Well, one thing that I think most of us agree on is that we are going to see a refi boom here in the next 12 to 24 months.
Wow.
Now.
So, I bet you can't wait. The mortgage industry right
now. Nobody can wait.
Yeah.
Although you don't get to have years like 20 and 21 without the pendulum going back the other way.
Right.
So if you were smart and you saved your money and you invested wisely and you didn't just go blow all your stuff thinking this wasn't gonna end.
Yeah.
Then you're probably okay.
Yeah.
But this is going to flush out a lot of people who either had just got into business or didn't live realizing that this wasn't going to last. It's going to flush a lot of people out, which frankly is a good thing because you don't need to have it. Same with realtors, right? Like you don't need to have an oversaturated market with people who can just put their sign in the yard. And with loan officers, you can't just say here's a rate and whatever, right? I mean, this is the time where true professionals come out and really can show their value because now you actually have to work. The worst realtor in the world last year could sell 10 houses.
Yeah.
Right. Same with a loan officer.
Yeah.
Now you really need to be. You need to be an advocate. You need to be an advisor. You need to be the expert for your customer.
Yeah.
Whatever that is. So when you talk about buy downs, you can spend 1.1%. 1 point equals 1% of the loan amount. You can spend that. You can get your rate down 1/4, maybe 3/8 of a point. 2 points might get it down another 1/4 or 3/8, right?
Gotcha.
Now, general rule of thumb is if you pay 1 point to lower your rate 1/4 of a point, it takes about 6 years to break even.
Gotcha.
Right? 5 years, 6 years to break even.
Okay, so repeat that because I think that's a good...
1 point to lower your rate 1/4 of a point takes about 5 to 6 years to break even.
Okay.
Which is a long time.
It's a long, which means you got a plan for that.
Well, the thing is if you're gonna not have this loan that long, then you wasted that money.
That's right.
Right. There's some different schools of thought here. Now, with rates being so high and so volatile, sometimes, especially if you're buying an investment property or second home, there is not what we call a par rate. There is not an option to not pay any points.
Okay.
There is no liquidity in this market.
Yeah.
All the investors buying loans, buying mortgage-backed securities, understand that these are not 30-year loans. These are going to be paid off in the next 12 to 24 months. So they don't want to pay a premium on them. And so a lot of this is going back to now you're seeing borrowers, especially investors, pay a couple of points on stuff. They're basically funding the liquidity themselves because investors, if I buy servicing from a loan, it takes me about 5 years to break even. So why am I going to buy servicing for something that I'm going to lose in 12 to 24 months?
Okay.
Right. One of the tools that a lot of people are talking about right now is a 2-1 buy down.
Yeah. Okay.
Right?
That's what I was going to go to.
So a 2-1 buy down, I do like them. I don't think that they're for everybody. I think you have to assess the situation, right? A 2-1 buy down is this. If your start rate is 7%, then for the first year, your payments are based on a 5% interest rate. And for the second year, your payments are based on a 6% interest rate. So rough math, right, on a $525,000 loan, you're going to save roughly $670 a month for the first year, and you're going to save about $335 a month for the second year.
Okay, qualifying question here. So that's it. That's like if today's interest rate was 7.5.
Yep.
Then your first year is 5.
5.5.
5.5.
2 points lower.
And then the second is what?
6.5.
Okay, so that's what I thought. Why would that not be for everyone?
So it's a great question.
Yeah.
Number one, in order to make it work, you need the seller to pay that for you. So again, now you're looking at, okay, I've got this $525,000 loan. It's going to cost about $13,000 to do the 2-1 buy down, because what the seller is doing is subsidizing the difference in payment.
Okay.
So you're taking the difference in interest over those 2 years, which is roughly about $13,000 in this scenario, and the seller is paying that for you, right? So if, say, in a year and a half, you go to refinance that, well, then you didn't use all the seller's money. Some people are looking at this and saying, hey, instead of the seller paying $13,000 for this just buy down for the first couple of years, let me just use that $13,000 to pay my closing costs, my prepaids, and my escrows, and try to limit the amount of money I'm coming out other than my down payment, right? When you qualify for a payment, or when you qualify for the 2-1 buy down, rather, you're still qualifying at the 7.5% rate. You still have to be able to qualify at that, right?
Yeah.
Now,
wait. Let me ask you this. So if it is for like a real estate agent that is writing an offer on this, what are they asking for the buy down?
Essentially, you're asking for seller paid closing costs.
Okay, so
you're asking for. Here's a great example. I have a deal right now. Working with a customer, property was listed at $580, I believe. They got it for $565 with $15,000 in seller paid closing cost. They felt that the 2-1 buy down was the best way for them to go. They really don't want they're very payment conscious. They wanted their payment to be a specific amount. I think it was about $4,100.
Yeah.
And so for the first year, by doing the 2-1 buy down, their payment is about $4,100.
Yeah.
The second year, it's going to be about $4,300, and the third year on, it's about $4,700.
Gotcha.
Right. So for this couple, the payment was the most important thing to them.
Yeah.
They didn't want to be in this $4,700 range. Right.
Right.
They wanted to be in the $4,100 range, but they really wanted this house. So
the thought here is that you refi after 2 years or whenever,
right? Whether it's 12 months, 9 months, 18 months, whatever it is, right? You've given yourself some runway to at least get comfortable with where the payment's going.
Yeah, because if you're saving $600 a month, I mean, it's not gonna, the cost of the refi is not going to be.
Well, here's the other thing about it, right? When you do a refinance, you're rolling in the closing cost.
Yeah, I know.
Loan, generally, right?
Yeah.
So here's your other thing, right? So right now you buy a house. Let's use round numbers. You buy a house for $600,000. I think that most people would believe that in December of 2023, that $600,000 house is going to be worth more than it is in 2022.
Yeah.
Right? You're going to go up.
Yep.
Right? So do you go up by 3%? Do you go up by 2%? Who knows? But your closing costs are going to be roughly about 1.5% when you factor in prepaids, escrows, all of that stuff.
Yeah.
Right? If you don't take prepaids and escrows into it, you're a little bit less than 1%. So as long as you appreciate more than 1 or 1.5%,
yeah,
then you've covered that.
Yeah.
Right?
Yeah. Right.
Versus waiting to go buy a house at, whatever, if it's 600 and you buy it for 610 or 615.
And honestly, dude, that's like if I think that if you look at anybody in the past 3 years that's been in this market, that has been a buyer in this market.
Yeah.
For me, it's absolutely silly for anyone to be waiting right now.
Well, sure, because look, before you had to put $100,000 over. You had to put in an appraisal waiver.
You got to go see one property.
Right.
A property tour with your agent was rushing to one fucking property.
Right.
And like waiting at the door.
Right.
And then sometimes you get in the car and it went pending while you're in the house.
Right.
So like now we've got this opportunity for buyers, and I just think it's insane that like we hear a lot of people that are really worried about it, and if you look, it's like this is the best opportunity I've seen in years, and certainly in 4 years,
sure.
if not more.
Sure.
Because prices have gone down a little bit.
If you look back, I was talking to someone the other day about this. If you go back and you look, people that bought in 2007,
mm-hmm.
right? Everything kind of goes south 2008, 2009, and these people, their homes were worth less than what they paid for them.
Mm-hmm.
However, you fast forward to 2012, 2014, 2015, they've appreciated a lot.
Yeah.
Right? So, nothing ever goes in a straight line.
Yeah.
So even people now that bought in May,
mm-hmm.
right? Anybody that bought in May bought at the very top of the market, right? Their home today is probably not worth what they paid for it if they were to resell it.
Right.
However, you fast forward 3 or 4 years, they're going to be ahead, most likely, of where they were when they bought the property.
Yeah.
Right? So that's things to keep in mind.
Mm-hmm.
They also had to put in, say, $100,000 extra to buy the house.
Yeah.
Right? Now buyers are able to keep their money.
Yep.
They don't have to go overbid $50,000, $100,000.
Yeah.
They can take their time on a property. They can get the seller to pay things like $10,000 and $15,000 and $20,000 towards closing costs.
Yeah.
Negotiate, right?
Yeah.
The sellers are back to paying title again.
Yeah.
The sellers are back to paying surveys
Yep.
again. Right. So rates are up, and it's a big difference, right?
It is a big difference, but I guess if you can afford it, it's going to look like a deal. Well, and it's especially, look, if we were in Chicago, I'd be like, maybe not. Okay?
Well, look at this. Right? look at it this way. So your payment's $700 more.
Yeah.
Roughly, say, based on interest rate.
Yeah.
But over 10 months, right? What's that? $7,000.
Yeah.
That's not $100,000. You're taking all that money that you were coming out of pocket, and you're paying a little bit more now.
Yeah.
Right. And then when rates come down, you refinance.
And they're gonna come down.
Of course they are. They will. It's just a matter of when and how much. But they will come down, and there will be another refi boom. Now, it will not be like what we saw the last 2 years.
Yeah.
But everybody that's buying now has an opportunity to get into a house for a better price.
Yep.
Than what we were having to deal with earlier this year.
Yep.
And they can take their time. They have options.
Mm-hmm.
It is a good time.
Yeah.
People would tell you, savvy investors would tell you, the time to buy is when everybody's afraid.
Yeah. Right. Yeah. Exactly.
And a lot of people are afraid.
Yeah. Okay.